presentation is going to be kind of a mix of academic and practitioner based. And in regard to building on what Jenny was talking about, ESG, what I wanted to do was look at what ESG really is from a practical perspective. First, to start off with, if you've been paying attention to the news, there's been quite a bit of there's political rhetoric. There's been a lot of discussion going on about what ESG is and what it means, especially compared to the shareholder model of capitalism and how there's an apparent conflict there. But I try to stay away from that. What I wanted to do was look at, well, if I'm looking at ESG portfolios, what does that mean to a financial planner? What does it mean to a client? And how do you explain that to the client? But I also have an academic kind of feel to that. But starting off with ESG, one of the issues with ESG, and I think Jenny mentioned this is an evolving field. And one of the primary concerns with ESG is how do you measure it? And there are some significant metrics. There's 3 to 5 metrics out there, entities that measure ESG. And one of the issues is they don't correlate. There's different measures of it. So there's subjectivity to it. And then if there's subjectivity to measuring what ESG means, then there's going to be subjectivity to how well it's actually performing compared to the financial performance. So that's one of the issues. So what I wanted to do was think about it from an academic perspective. When you think about ESG, what I started realizing when I started going through this process was it's a values-based proposition, okay? And so there's a style that's ultimately involved with this decision. You're putting forward maybe a qualitative interest above short-term profits or maybe that shareholder model of maximizing shareholder wealth, okay? You're putting forward whether it's sustainability, the environment, social concerns, or governance. But with that being said, if you're doing that and you're pulling from the universe of opportunities, this is where I'm going to get a little academic. When you start removing from the universe of opportunities, you either diminish returns or you diminish the risk-reward relationship. That's called the Markowitz portfolio. And there's a chart that you have to imagine, but it's not there right now. But basically what I'm saying is, if you imagine only investing in the United States, if you invest internationally, you have a greater opportunity to diversify. So what happens is if you start pulling ESG, high-rated ESG stocks out or low ESG stocks out of your portfolio, then you should have some kind of diminishing return or some kind of diminishing diversification. Statistically, you should, based on the Markowitz efficient frontier. So what I did is I did an analysis. I did an analysis of the ESG 500 versus the S&P 500, 5 and 10 years. I finished the analysis last month. I'm on through my numbers, double check them. I did the ESG 400, which is the mid cap versus the S&P 400. And then I did the ESG 600 versus the S&P 600. I expected fully that the ESG would underperform the benchmark. It did not. About half the time they were within 0.1% on an annual basis. I was like, well, that's really odd. And on the risk characteristics, I looked at standard deviation and the beta coefficient. I looked at total risk and systematic risk. And their betas were all 0.9998, 1.00001. Statistically no different than the market. I thought, wow, this is really odd. And I found it surprising. I ran it by Amon again. Maybe I did my numbers wrong. He said, your numbers look right. And, I felt good about it. So what I did is I did the first level, what's called an attribution analysis. Next slide. And one of the first things you do in an attribution analysis, all I did here is I compared the S&P 500 to the ESG 500. And I wanted to get to like a nuts and bolts, what the difference is. And I started pulling it apart. And one of the things you're going to find, I identified certain sectors that the ESG 500 has a higher weighting versus the S&P 500. And I've read materials where the ESG related stocks that perform well on those metrics traditionally have lower debt, they have lower costs of capital, obviously they have lower carbon emissions, they have less reliance on fossil fuels. But what you effectively do when you look at this, you'll see that they're heavier weighted in information technology, which makes sense, it's a service related industry. There are lower weightings in consumer discretionary. These are the automobile manufacturers. These are heavy manufacturers, industrials, and utilities. And across the room, there's people in accounting. These are entities, these are sectors and industries that are high in fixed assets. When you're high in fixed assets, you usually have more debt. When you have more debt, you usually have a higher cost of capital to your shareholders because there's going to be a reward for that relationship. So when you're looking at these sectors, what I realized was you actually have truly a style. And this is the style that when I actually start going through it, these ESG high-rated sectors or these ESG funds that are high-rated are heavily weighted towards service industry away from manufacturing. But then I got to the point, wait, if I'm excluding a lot of these industrials and consumer discretionary and I'm low in utilities, how is it that my beta still so close? So I did it my secondary analysis, the third analysis I did. It's called a heat map. And what I did is I looked at what's really driving the S&P and what's really driving the ESG 500. And if you follow along in financial planning, they are both market cap weighted, which means the size of the company, the number of shares times the average shares outstanding, that's the weighting within it. Well, in the ESG 500, it's tech heavy. The S&P 500, it looks like it's 27.9%, but that S&P 500, the top 5 companies in it, and you can name them, we know who they are, the Apples, the Microsofts, the Metas, they represent 25% of the total weighting in the S&P 500. So you're going, wait a second. So 5 companies out of 500 represent 25%. The top 10 companies represent 30%. So that means the remaining 490 companies represent 70%. What's happening over the last 5 to 10 years is that whether you're ESG or not, you're benefiting from those 5 to 10 companies that have really strong ESG ratings. You might be holding an S&P portfolio. So that's one of the things I learned is that you might think you're not ESG, but you probably are, because those top 5 companies are all pretty strong, they have strong ratings. The last thing I want to point out, and this is just a continuation of what Jenny said, more than likely in the next 50 years, when we choose our alternatives in our investment plans, retirement plans, our 401ks, there's going to be an option there. And it may already exist for many. There's going to be an option that's associated with whether it's sustainability or ESG, whatever you're going to call it. We may not be calling it ESG, but there'll be something there that's associated with the environment. The last part I'll say is ESG, when you look through the ratings, heavily weighted towards the non-use of fossil fuels. And that's why you see consumer discretionary industrials and utilities. If there's any reliance on fossil fuels, and I looked up industries including chemical, plastics, anything involving petroleum distillates, they get very low ratings on it. And those low ratings will actually pull down high ratings in other areas. So they're actually pulled into this vortex. So no matter what you do, there's very few utilities, almost half the utilities can never get out of that vortex because they're relying upon either coal or natural gas, and natural gas some will look at as clean, some do not. So when you look at that, if you're going to hold that portfolio, just realize you're holding a very service-related, heavy service-related portfolio versus kind of the old school manufacturing fixed asset portfolio.